This is the danger zone for people. This is where people make just gigantic mistakes with their money.
So far at the beginning of this year, there's been a shift out of tech stocks and into other sectors.
Your share price is going to come under pressure when those numbers start hitting this year. And by the way, it's an earnings month. If that blows up, it blows up your whole entire potential retirement. What could really be a good year or a bad year for a lot of people if they make mistakes. Good morning and welcome to the Wise Money Guys radio show, our first one of 2026. I'm your co-host, John Scambray, and I'm here with my partner,
Giuseppe Visconti.
And if you're listening to us for the first time, we probably should mention who we are and why you should listen. So both Giuseppe and I are certified portfolio managers. We operate a registered investment advisory firm. We primarily use Charles Schwab to custody our clients' accounts. But the most important thing is we've been doing this a very long time. We specialize in helping people who are retired or about to retire manage their money. Mainly, and I should say, when I say manage their money, we help them create a plan to manage their money, and then we help them stick to that plan and check in and make sure we're achieving the goals and objectives that we help you create. Today is, it feels like the first day of business for me. I don't know about you, but
you have a hangover from the holidays?
Well, last week was kind of quiet, right? Just the way the holidays came, but So here we are, here we go. We did mention on our show a couple of weeks ago, some of the themes that we thought were going to happen in 2026. We'll talk about those themes again because they're super important, especially when it comes to how you may be rebalancing your portfolio, or hopefully you're rebalancing your portfolio or have done some adjusting based on how things ended in 25, based on how things look in 26. So that's what we're going to talk about. We'll do a little recap I see here in your notes, and then we'll talk about 2026, and hopefully you'll get some good advice, not advice, but information that can help you make a decision when it comes to who's going to help you in 2026 manage your money. Our number is 916-967-3500. Again, that number is 916-967-3500. You can find our website and lots of information and the disclosures that we're required to put on our advertisements down at the bottom of the page. So you can go to wisemoneyguys.com. And as always, when we talk about investments, it is not intended to be advice. And of course, past performance is not a guarantee of future results. And all investments can lose money. So in fact, if you ever hear anybody say, this is absolutely guaranteed, you cannot lose a dime, we always say, run fast from that person, and then call us at 916-967-3500. So let's talk about a couple of the things coming up.
Let's recap.
You want to recap
2025?
Oh, let's talk about our model,
and then our models, and where things of how it compares to other years. We had another positive year in 2025. So 3 years in a row. We had, coming off of 2022, which seems like some people already forgot about. But was a rough year. It wasn't recession, but a lot of people and investment analysts and economists were calling for recession in 22 and 23 because we had a bear market in 2022. Markets were down 20 to plus 30%. Bonds were down 10%. And then 2023 came out with a bang, had a healthy double-digit return. 2024, another double-digit return. And last year, another double-digit return.
Going to call that a super double-digit return?
Well, it's 3 years in a row. So, do we have another double-digit return or another healthy market in 2026? We'll come to find out. We'll talk a little bit more on what our thoughts are a little bit later. But 25 S&P 500 finished at just above 16%. And we track that because we use it not solely as just the only benchmark, but we look at it because it's
Well, it's the broadest picture of the stock market, right? I guess you could use the Russell 2000 or something like, or the IWN.
Wilshire 5000.
Wilshire 5000.
Wilshire, that's a basket of everything in there.
Yeah.
S&P 500, because it has, 500 or just about 500 stocks in U.S. companies within it, but it's been so out of balance the past few years because
of the Mag 7.
It's 7 or 10 names of that of the 500 that really, and we've talked plenty about it, that really carry the big weight of the index. Nevertheless, when you're watching financial news or news in general, and they're talking about the stock market all-time high, they're either talking about the Dow Jones, which is the oldest, S&P 500, or NASDAQ. And a lot of times when you're looking at something, like you said earlier, broad, typically it's reference of the overall market is S&P 500. So a little above 16%, which is a great year in the market. Not as good as it had been the previous 2 years, which were in the 20 plus range in the previous 2 years is what the S&P 500 performed. But we're very happy with our models that we've been tracking. There's two in particular, one that's built around just growth and been tracking it, built it mid 2022, been tracking it and then starting adding some clients that it made sense for them in their portfolios and their risk tolerance. Last year finished, and it's only 10 names. So basically it pulls from the S&P 500. It only picks 10 names from that. You're only invested in 10 stocks at one time. It takes a look at it every month to see if there needs to be any changes, if we need to swap out a name or not.
It's we. Basically.
Are you speaking French like we?
We. Yes. Well, saying it pulls, it does this. It's
our model.
Our yes. So we, our, so not it, like it's some standalone, mind, like,
yeah.
But anyway,
it reminds me of some cartoon that my kids watched, and there's like a bunch of seagulls. I'm trying to think of what it is. Anyways, there's a bunch of seagulls that come in. There's like this object, and everybody wants to go after this object. And then these seagulls all land. And they're all mine.
This is the type of value you can get from this show. We have cartoons.
When I think about the movie, I'll come back to it. Anyways, so our model that's growth oriented, trying to go after just the gusto, albeit it has volatility, but it goes after the gusto. Finished a little above 47% last year. Comparative to the S&P 500, which finished at just above 16%. So very proud of that. Leaps and bounds above what the S&P 500 did.
And here's go ahead, finish your thought, because then I have one.
Go ahead.
Well, more than one.
I'm more curious as to hear what you have to say.
Well, when you talk about those kinds of numbers, even the 16%, and 3 years in a row at double digits, this is the danger zone for people. This is where people make just gigantic mistakes with their money.
Comfortable, complacent.
They start wanting to get on the bandwagon, and they want to buy, the investments that helped, drive such lofty, great, 3-year, multi-year returns. And it's not going to be the same companies that this year, some of them might do well. I think there's some upside to Amazon and Microsoft and Google, so on and so forth. But I don't know. Is NVIDIA going to have the same sort of?
Is tech going to lead the market this year like it did the last few years?
And it might be energy that is going to be needed to drive tech as far as utilization, right? Tech is great, but again, you have to put the application to use. Right. And in order to put the application to use, when you're talking about AI and data centers and all that, they need power.
Right.
And power was kind of a forgotten sector last year.
Well, it's been talked about. I think the back half of last year, it's been starting to.
Now you're starting to see some lift, and clients are starting to, notice that, okay, hey, maybe John did know what he was talking about when he said, energy, everything begins and ends with energy, and every type of energy to power today, which is tomorrow, because yesterday's tomorrow is today, by the way.
Thoroughly confused now.
But you can't do anything without energy. So where I was going with that is, I think the mistakes that are made here when it comes to portfolio construction and management and ongoing management of your investments is to not do anything, to just think that wave is going to be the same wave that it was last year. No, I think there's definitely, going to be more of a shift as far as what are the high flyers from a stock, multiple this year versus last year.
Right.
And it was all about the AI chips, right? And semiconductors last year.
Mm-hmm.
This year, I think it's going to be more about automation, robotics, things of that nature versus, the things that are underpinning our technology and the power that it will take to put all of this new technology.
And the other thing is it doesn't always have to revolve around AI. I mean, so far this year, what's been doing very well is some energy names, healthcare, biotech have been actually doing better than some of the tech names out there so far this year. I mean, we're only, 10 days into it so far, but we'll see if that continues. And it doesn't mean that technologies, I'm just going to focus on that and have my portfolio, amongst several different names, but then you're all in the technology sector. You're not diversified, right? You could be in a bunch of different names and maybe you have this company and that company and that company, but it all revolves around AI. You're not going to be totally diversified because if the AI thing turns around or it gets disrupted, then all those stocks that you have in companies, can take a hit. So,
well, or if the institutions that, wield the money, especially money in retirement plans and things like that, are primarily in funds and models.
Yeah.
And all of a sudden you start mathematically coming to the realization that, okay, there was probably $1 trillion of spend in the development of
spend and investment. Yeah.
Investment of AI, but no revenue. At least not revenue proportionate to the spend.
Exactly. Yeah. Right.
And so when you start going, okay, the fact that companies went up double and in some cases triple digits because they decided to spend and invest in AI, but then from a profitability perspective, when you take on those expenses and you don't get there's no immediate return on investment, there's no immediate revenue. Well, shoot. Your share price is going to come under pressure when those numbers start hitting this year. And by the way, it's an earnings month. And so, you need to stay tuned because we're just getting into tidbits of what could really be a good year or a bad year for a lot of people if they make mistakes. So stay tuned. You're listening to the Wise Money Guys. We'll be right back. Back to the Wise Money Guys radio show. John Scambray and Giuseppe Visconti here, certified portfolio managers who specialize in helping people who are retired or about to retire manage their money. If you like the show and want to have a conversation with us with no obligation, give us a call at 916-967-3500. Again, that number is 916-967-3500. So, yes, things were a little bit topsy-turvy and one-sided in 2025. But even with that, the core model.
On the downside and upside, because we had April and May and, market came down because of the tariff, but a lot of the tech names had some big hits to them.
Some were down 50%
right
in April and May.
And the market went down overall 20%, but yeah, there's some names that were 40, 50%. A lot more of those tech names that had run up quite a bit. But on the flip side, when things started coming back, Feds were talking about potentially starting to cut rates again, and tariffs were starting to get delayed and relaxed. Then AI euphoria came back, and we saw some big names. Case in point, one candidate within our, not candidate, but one position that's still a position within our S&P top 10, the growth-oriented portfolio, triggered WDC, Western Digital, in beginning of August. And since then, just from August until now, since then, it's up to, I think it's last I checked was around 160%.
Yeah, it's been
from August,
but
that's crazy.
But then there's even way bigger ones like the Palantir growth.
Palantir was that's been in there longer. I want to say October of 25, actually maybe 24. It might be in there for definitely more than a year, and that's up over 300%. That's had some volatility, but I mean, still.
Well, think about it. Palantir, for example, when I first introduced you to the radio show, we were talking about that in early 2024 when it was like a $12 to $20 stock.
And gold.
So
you were mentioning,
and I was gold, buy Palantir, buy this, buy that, the other. But that's neither here nor there. The point is that themes are important, and recognizing, themes is a big part of our job. And the way that we come up with these themes is through research, through reading, and through process, and through being students and more than full-time students of this game. You can't expect the same level of return every year from doing the same identical thing.
Right.
The market as a whole, the stock market as a whole, has averaged over the last 50 years about an 8-9% return. So if you're now getting greedy and
because you're used to the market for the last few years,
the last 3 years where good sized double digit returns, it's going to bite you. And we don't want to see that happen. Come in, let us put eyes on what you have and what you're doing, and make some suggestions on what we think you should do to improve your portfolio.
Well, more importantly, put a plan together so you have a roadmap to then figure out what your portfolio and your investment assets and how they should be, how the hard money that you've earned, right, over your lifetime, and how it should be allocated based on your actual roadmap and your plan to align out. A lot of times, and what you're getting at, I'm guessing, is, you had a great 23, 24, and even last year. And so you're just throwing it and saying, I'm going to invest. Right. Yeah. I'm investing in this fund or a tech fund or this or that or whatever. And I'm just going to continue to, well, do you need 20% a year return? And along with that, do you need the risk that comes along with 20%? Because it's not going to be a double digit return every year. There's going to be down years like we just, recently went through in 2022 that a lot of people forget because we've had such good returns in the past few years. So do you need that? Is that what you're needing and asking for? In order to obtain all of your financial goals that are important to you and your family? If not, then that's where we can go through, do an analysis and say, hey, you need to make some changes here, either to your overall allocation, to the granular steps of here's some positions, so on and so forth. This is what it's going to mean. And if you do these different adjustments, then this is how it's going to align better with your plan, reduce some risk, take unnecessary risk off the table. Not that you're not making any returns, but you're making the returns that you need to make based off of your plan and your trajectory and your timeline, without just throwing risk out there just for the sake of, hey, I want to try and do 100, double my money in the next 2 years or 3 years,
which would be lovely, but not reality.
And people have done it. And we just gave you an example of one position within our growth portfolio that, you've already more than doubled your money, but that's not. But again, even though we are able to do that, we've tracked it, and the portfolio did 47% last year. I'm not banking on it to do. I don't have the goal or trajectory to say like, oh, I did 47 last year. I'm going to bet that this thing's going to do 47% or better this year.
And that doesn't mean the person's account grew by 47% last year, because again, it still comes down to not investing all in one, or over investing in one segment or
asset
opportunity
class.
Or asset class of the market.
Right.
And correlation is important. So again, when you do the plans that you're speaking of, it might say that, hey, a realistic return for you to accomplish your needs, not the wants and wishes, because that's the other thing we'll help you identify. But what is it you need from a return perspective that I call minimum return to objective? And if that says 6, 7, 8%, well, that's what your core portfolio should be. And then you might have a portion that's in a more aggressive stock model where it's individual stocks that are designed to, go for a more aggressive growth rate of return on your money. But when it's only a piece and a very calculated piece, then it's appropriate from a risk perspective, because it shouldn't throw off your plans and your goals to accomplish your needs first. Because if you have way too much money in something that's too risky, if that blows up, it blows up your whole entire potential retirement plan and your future during retirement. Right. And we won't let you do that. Right. So a lot of people, they see the types of returns on certain positions and they're, well, why didn't we put all of our money in that? Well, because nobody has a crystal ball, so it's important. And that's why I said at the beginning, this is a really risky time frame right here, because people's objectives start getting skewed. They start getting skewed with
what's the expectation, right?
Yeah, the expectation.
It's done it for the past few years. I'm expecting it to continue on. It becomes indestructible. It's like when me and you, when we're like in our teenage or young 20s, we're indestructible. Yeah, we could do anything, jump off anything, roll, drive anything, get into a motorcycle, and you can recover. And now I'm in my 40s, you're in your 50s, and totally different game now.
Oh yeah, everything hurts now. More so for me.
Right, but hindsight's 2020, and so that's what we do. Is we use not only our combined experience of over 50 years, personally, but then also the experience that we have with all of our clients, right? Because everybody has a different story, everybody has a different background, and so we, the culmination of everybody's experiences, ours personally, with all the clients that we have been able to service over the years, we take that and are able to tell our clients, when we're drawing out a plan, answering some of their questions and what ifs, especially, is what might be around that corner, right? Ahead in time. What are some of the things that you want to potentially prepare for of the what ifs?
Yeah.
Right.
So here's some of the things in 2026 that again, if you're not looking out for these things for yourself, hopefully your advisor, your advisory team, whoever you're working with is looking for these, challenges that will make 2026 rocky. And once again, it's all tied to interest, inflation, and employment is some of the biggest headwinds potentially out there that could be tailwinds. It just depends on how things shape up early here in the first quarter. And then on top of that, you still have geopolitical issues now,
like Venezuela,
Cuba. Russia's been, following Cuban oil tankers with subs.
Yeah.
And so China, get into another
still have
Cuban missile crisis type thing.
Yeah.
In the Latin America areas
seems to expand instead of shrink.
Yeah. And so tariffs are still a big thing, but here's the other thing that's coming right around the corner.
Let me guess.
Guess what it is?
I want to hear you say it because you're just so emphatic about it.
Another government shutdown.
Right.
And that's going to cause volatility. I think
not only that, but we have earnings. So we have all the big Mag 7 names, some of the big Mag 7 names that are going to be reported. We have FOMC at the end of the month, which is going to be an interest rate decision. And in May, Fed Powell is going to be gone. So who's going to replace him?
Hallelujah.
Maybe, yeah, we'll see who's going to replace him and how's that going to impact the markets.
Well, hopefully, and this is one of my favorite topics, as you know, is that we see some sort of revamping of the structure of the Fed.
Yeah.
Right. I mean, the dual mandate, the dot plot. I mean, that is such an antiquated philosophical view of our economy.
But the dual mandate doesn't really matter if they're sitting there and they're forecasting, because if they just go based off of the dual mandate, that's thrown out the window. That's thrown out the window. Dual mandate's fine, but it's used differently now. Back then in Alan Greenspan days and prior, it was if one of these things or both of these things get out of whack, then we have to act, right? But when they were out of whack when we had inflation, it was, we see that inflation is above where we're comfortable, but we think in the next 6 to 12 months, because of supply chain and this and that and Big Bird and R2D2, it's going to come back and then right? That's the problem.
Well, the biggest problem of the Fed is that they think growth is the problem, right? Since when is a growing economy a problem? But a growing economy could lead to some inflationary pressure if productivity it becomes an issue, right? And then obviously supply side issues. If demand starts outpacing supply, then once again, it's those things. Or if you don't manage your checkbook well the next few years, then you're going to put pressure on the dollar. The dollar is going to be worth less, and i.e. hyperinflation. So there's lots of those same themes that if you're mismanaging your money, or if it's being mismanaged for you from a risk perspective, you absolutely need to give us a call at 916-967-3500. And stay tuned. You're listening to the Wise Money Guys. We'll be right back. Back to the Wise Money Guys radio show. And I kept cutting you off every time you wanted to talk about the core portfolio.
Gosh, John.
So just to recap a little bit, we have two portfolios that are our main love, if you will, as far as
on the stock
side. And then of course our new love is structured notes, which maybe we mentioned the one coming up this next week. Is it next week or is it? Yeah, it is next week. But anyway, we run two models that are when people have, a moderate aggressive or aggressive risk tolerance, then we'll put you in a portion in the growth portfolio when you're more aggressive. If you're less aggressive, then we'll put you in the moderate growth and income portfolio. But
let's take it a step back just in case, put it in layman's terms. In general, when we're working with,
we're laymen or just people are laymen.
Where are laymen? What country is that from anyways? Laymany?
Oh, well, that makes sense. It's from Laymany. Sorry. I don't, it's the first one of the year.
So, in general, we're working with clients and we're figuring out, we put together a plan and figure out, okay, what's needed from the assets that you've grown, or maybe you already have some of them invested or not. How do we allocate this? You can be anywhere from conservative to aggressive. And then within that, assets are going to be diversified through different asset classes. So one of them is stocks. That's the two models that we're talking about, right? That is focused on stocks that we've talked about in the beginning, kind of the performance and how it's done against the S&P 500. But then there's other asset classes too. So it's not just that. It's bonds, it's alternatives, it's real estate holdings. And when you think of real estate, we have clients that have hard real estate where they own them. It's very common. But it could be that, hey, I want to own real estate, but I don't want to actually buy the hard asset, manage it, find a tenant.
Or I don't want a single property.
But I want to be able
to. Property.
Yeah, I want to be invested in it. And so we have investments, both public and private, that we have access to, that we put a little sliver within their portfolio. And so now you have different asset classes within your portfolio, right? That kind of act as a balancing act, and it's not all in one type of thing, not all eggs in one basket, because you can't predict exactly what's going to be doing well at the end of, this year, for example, or the next year. Are stocks going to do well, or fixed income, or real estate, so on and so forth. So depending on if you're conservative, then you're going to have most likely less exposure to stocks and these couple of models that we've been talking about, versus if you're more aggressive, you can have more exposure to stocks because that's the more growth component to get you that extra growth and the higher potential returns within the portfolio. But one is purely growth oriented, more volatile, going after the gusto, which is what we talked about before, that performed just above 47%, right? Last year. The other, which is more common in our clients because more of our clients aren't aggressive and trying to just grow their assets, right? They're either nearing retirement or in retirement and trying to generate some cash flow. So how do you do that with a stock portfolio and still generate cash flow, but have a, attractive return, or not giving up the overall average return just for cash flow. And so we've built a model. And, when I partnered with John the beginning of 2024, that was kind of the project that I got excited about, was build something that's custom, that we can replicate and put in client portfolios that make sense, that they can have exposure to stocks, but will generate a decent cash flow. So the other one, we call it our core stock portfolio, and this has 30 holdings. But the caveat to it is that a majority of them, 20 of the 30 names have to be some sort of dividend paying stock. And the average that it's been averaging over the past year is north of 3%. Sometimes it's 3.1, sometimes it's 3.3% as far as a dividend yield. Now, dividend yield, when we're saying that is the cash flow that stock or portfolio generates, that spits out, that you can either reinvest in the stock and buy more of the stock, or some of our clients take those dividends out and they use that as basically their income, right? To pay for things, pay for expenses, what have you. Wasn't built to try and beat S&P 500, but so far it's done a good job. And last year, the overall return of that portfolio has performed at just over 20.5% last year, while averaging north of a 3% dividend yield on the portfolio. So proud of that as well. Again, past performance is not indicative of future results, but we continue to monitor that and make any necessary adjustments. Definitely review it on a monthly basis to see if there is any tweaks that we need to make of it. And haven't built it to just beat the S&P 500 for growth, because it's income first, growth second. But been pretty proud of where it's going, and we're going to continue to work on it.
And we do this, we're fiduciaries. So since it's the first part of the year and we're talking a little bit about, what we do. So obviously how we do it is important. So we are discretionary money managers. We're fiduciaries, means we don't work on a commission. We are fee only. So that's important. At least we strongly believe that whoever is manage your money and help you create and maintain and hopefully achieve your plan, is that they're doing it on a non-commission basis. We think that's super important. So just to let you know, that's what we are, is a fiduciary firm and a fee-based firm, like Fisher Investments. Fisher Investments, I love it. He says it like there's something, unique about what they do. By the way, we do good when you do good. Yeah. All that means is they're a fee-based fiduciary firm as well.
It's true with us as well. But the other thing that I think is important to note is that we're agnostic. So we because number one, we're not focusing on selling products and solutions that pay an upfront commission to us. We're agnostic of what's inside of your portfolio. We don't care, right? We're not tied to any specific investment firm and mutual fund company or anything like that. We don't get any kickbacks or anything like that. We use Schwab as a custodian. We have Interactive Brokers. We have Fidelity as custodians. So it doesn't really matter to us. What matters is what is needed per your plan after we design it, and then what makes sense of the portfolio, and how can we basically give best bang for the buck so you're getting the returns that you need to over time without taking any unnecessary risk.
Speaking of unnecessary risk, I really love these structured notes that we've been working with a partner to have created, that we've put a lot of clients' assets in. And the reason being, so when they're kind of on the fence or in the middle of the road from a risk perspective, okay, they're not aggressive, they're not conservative, but they want more of a stock-like return without having 100% stock-like risk. Well, that's where a structured investment comes in. And again, we don't put, all of people's money into any one thing or into any one category, as we mentioned before. But these structured notes are really kind of a fixed income, are a fixed income investment that has a stock-like return. And right. So the one that we're going to put some of our clients' money in this next week is a 3-year investment. It has a coupon which is paid by the issuer. In this case, the issuer is Citigroup. And the coupon was what was it annually?
Yeah, 9.7.
9.7% annually, paid out 1/12 a month, as long as the indices that it tracks, and it tracks three main ones, aren't down any given month from your starting point 30% or more. Now think about that. If I'm just in a regular stock fund or individual stock, and I'm looking for a 8 or 9% return on average that the stock market has done over any given decade, over a long term, I can get this with a 30% kind of barrier, which is a cushion that just means that as long as the S&P 500 or the NASDAQ, again, each one tracks different indices. So it's just, we're talking at a high level right now, then, I've got a pretty good comfort level and a pretty good probability, not guaranteed. Again, remember I said in the beginning, if somebody says this is guaranteed, run away. And I hate to say this, but you could think of an indexed annuity, if you will. They use the same sort of strategy to, get you a high return with reducing your exposure on the downside. And so 9.7, annually for 3 years, that is fixed and written on the note. And as long as the indices, as I said, that it tracks, stay above minus 30%, you get paid that 9.7% each of the 3 years. Now, the only other downside to it,
there's two,
is it could go below minus 30%, but you'd be going below minus 30% in your stock fund or stock potentially anyway. And
you don't get paid out that month, but it just goes on to the next month. And if it's
might get paid that.
Yeah. If the market recovers, but it's down 27%, it's not down 30 more, you get paid out that month.
Yeah. That's the beauty. But the real thing that we keep experiencing is that they get called early.
Right.
So as rates continue to go down or be volatile, a lot of the issuers, in this case, the one that we're doing next week, Citigroup, they can refinance. They can pay back investors early. And then all of a sudden you're so excited about the 9.7%. And then we got to find something else for you that's as good. So that's the other downside of it, is that it could be called early, which is the downside of fixed income investments in general, bonds in general.
Yeah, the ultimate risk would be something financially happens with Citi, and then they're not paying the 9.7 or your principal back.
Boy, and if a bank the size of Citigroup defaults,
we already saw that in 2008.
Its bonds, and look,
we saw that in 2008,
right? And look,
the government didn't want to let anything
default
like that happen.
So, but that is the ultimate risk. But let's face it, that we're talking about today that, people are going to want, high returns because that's what they've been used to now the last 3 years.
Other ways to achieve a good, healthy return, but how do I do it without taking unnecessary risk? And these are just some of the things that we look at outside of just the plain vanilla stocks and bonds.
It's just one additional arrow in our quiver of arrows to help people achieve whatever their goals and objectives are for their money each year. So we got more to talk about when we come back. You're listening to the Wise Money Guys, John Scammer and Giuseppe Viscani. Stay tuned. We'll be right back. Back to the Wise Money Guys radio show. I'm John Scamber, your co-host, with my partner Giuseppe Viscani, and this is the time where we can talk about some of the themes again.
That's what you're gonna sing, like the final count.
I didn't know what we were going to talk about. That's the thing about doing a live show, is but
it's the final countdown.
But let's relook at the things in 2026. Now, we mentioned them briefly, but they're important. So they're worth mentioning again, because it really is, as we were discussing during the break, we're seeing
market movers.
We're seeing a rotation, right? And
Mm-hmm.
we're seeing market movers be different, as already mentioned, than what the market movers were in 2025. Right. So, again,
so there's been a little bit, so far at the beginning of this year, there's been a shift out of tech stocks and into other sectors. Dow is outperforming NASDAQ, which is, completely different from last year. It was all about the NASDAQ and the tech stocks within the NASDAQ. And it's just broadening out beyond AI themes. Healthcare, energy, biotech have all been seeing pretty positive, returns and spikes. Small cap, we haven't mentioned that yet, but small cap stocks, which all that means is just smaller sized companies. And I've been seeing some of the biotech pharmaceuticals that have been getting some good momentum this year. But small cap stocks can have been doing fairly well. They did well back half of last year. And primarily that was driven from the Federal Reserve cutting rates again. Now, if that theme continues this year, where there's more cutting, whether it be from Jerome Powell or the new Fed chairman that's going to be coming in, whoever that might be, and maybe they favor and is more on side with Trump, and they decide to cut another 1% of overnight interest rates this year, that could be favorable to small cap stocks. So that's a sector to look for as well. And emerging markets actually have been surging outside of China, not only just general, but more on the AI theme and revolving around that and the emerging markets. They did actually fairly well last year. International did, but emerging markets have been kind of coming out of the woodwork. So there could be different areas, like we said before, outside of the typical names that you hear about all the time, NVIDIA, Tesla, so on and so forth. Although we are excited about Tesla and SpaceX, which SpaceX just announced, and they are going to be going IPO here, trying to. And there's some offerings. Actually, we're trying to get some clients, a couple clients into SpaceX specifically. But those are things that we look at as well as, private equity, alternative credit, alternatives, real estate, all these different asset classes, or different investments within asset classes you typically don't have access to. You can't get access to as a retail trader, and further diversify your portfolio outside of just the vanilla stocks and bonds realm that most people have when they're just trading and they have a portfolio of mutual funds or ETFs.
Yeah, I think it's worth mentioning. We had a client. She had family partners on a property sold. There was no debt on the property for, $6 million ish. Each of the family members, I believe there was 4, got about $1.5 million. Gosh, it was an inherited property. So there was almost no cost base to the property, and
it was a low cost base,
depreciated. So, cap gains were going to potentially be huge. And we helped that client put it into a private real estate investment trust, a very good one, where it was 1031. We helped them set up the intermediary. That's one of the nation's best, or at least one of the nation's largest, where the money transferred from title to the intermediary, and then from the intermediary to the new real estate investment for the client. And the client.
This isn't an investment where it's another hard asset that they need to manage. It's a portfolio that's professionally managed,
particular
on an institutional basis.
This particular real estate investment trust has around 300 properties in it, and very high occupancy in the 90% occupancy rate, which is very good. But the other part that's just fantastic, when you look at the potential cash flow, it was higher for this client on her cut than what she was receiving on the bigger property with the rest of the family members when they divvied it all up. And here's the real wonderful thing about these: because the overall portfolio passes on its overhead and expense and depreciation and costs to each of the owners and shareholders of the investment, the 6.12% annualized rate of return or distribution rate is mostly not taxable. You heard that right. So mostly not taxable, 6.12%. Now that might fluctuate a little bit as far as what the annualized cash flow is, but we can help you literally with liquidating a property. It has to be an investment property. It can't be a primary residence. And where it's highly appreciated over, whatever the time frame is, and you don't want to pay cap gains. There are wonderful investments out there. We set up pretty one. We do all the heavy lifting for you. It gets networked into your your trust, your joint account, your individual account, whatever the case may be. Can't be an IRA. And the income off of it is almost all of it not taxed. Over 90% of the income paid out to the owners of the shares and the properties aren't getting taxed on that cash flow.
Yeah, and that's how they've been able to manage it. Now, it's not a guarantee, but they've been doing such a good job of passing along, the expenses and the depreciation and 1031 their own properties into other properties within portfolios and passing those tax savings on to their owners and investors.
So if you'd like more information on anything that we talked about, or more importantly, want to meet for a no obligation consultation, and I recommend doing it early this year, I think we can help you set up a pretty good year. We don't know. We think it's going to be challenging, but overall, we both think the year should be a good one. So let us help you take advantage of the themes that are out there, and let us help you not make mistakes in 2026. Give us a call at 916-967-3500. Hope you enjoyed listening to the Wise Money Guys, John Scambray and Giuseppe Viscani. Have a happy Saturday, and come back and listen to us next weekend. Bye.
Have a great weekend.